Everybody wants to see their actual numbers. You've learned about this loan, but what does it actually look like for a normal situation? Well, that's exactly what I'm going to do today. I'm not going to tell you about the loan. I'm going to show it to you. I'll take a normal situation and run it through the actual simulator. And then I'm going to put it head to head against a traditional 30-year fixed mortgage. Same people, same income, same house, just two different loans. Then stick around because I'm going to show you the one number that you need to pay attention to because it shows you if this loan even makes sense for your situation. So a quick reminder on why we're even doing this. A 30-year fixed mortgage is expensive. It was designed to help people get into a home, but not get out of the loan. It was designed in 1930 after the Great Depression to help maximize home ownership, which has been great. Home ownership is the American dream, and I want people to all achieve that. That being said, it shouldn't be a one-size-fits-all box. There should be some incentivization for people who are smart with their money, have positive cash flow, and do well with their finances. And that's exactly where the all-in-one loan makes all the difference. Now, I want you to back up for a second and think about this. What if every single dollar that was deposited into your checking account paid down your mortgage at the same time? I'm not telling you to change your spending habits. It's just now, while the money sits in your checking account waiting to be spent on groceries or gas or vacations or whatever, it's actually working for you. This is the definition of money working smarter instead of harder. Because like I said, the 30-year mortgage wasn't built for every situation. It was to get the masses into homes. While meanwhile, a large portion of Americans will have more money flow through their checking account in a 5-year period than their entire loan balance. Anyways, let's stop talking about this and let me show you. Okay, so today I'm going to do a scenario with a married couple. We'll say they're buying a house for $650,000 and they're putting 20% down. So that would give them a $520,000 loan amount. Let's compare this versus a 30-year fixed mortgage. We'll say a 5.5% interest rate. Let's say that they got a really good interest rate. Today, July 2nd, 2026, they probably paid some points for that, but let's just compare it. Repeat deposit. Let's say after taxes, their net that is deposited to their checking account is $15,000. We'll say we get that monthly. Let's say in addition, they have about $10,000 right now sitting in their checking account as their buffer for everyday spending. That's going to be deposited into the all-in-one loan the day that they open the account. Taxes and insurance, we'll just use this estimate here. That would leave about 11 grand left over for everyday spending. Cars, eating out, groceries, gas, vacation, everything, right? So let's say out of this $11,000, this couple, on average, has about $2,500 left over. So with the all-in-one loan, this couple would pay off their house in 11.5 years. Let's compare that to a 30-year fixed. It takes 30 years, and this is at a 5.5% interest rate. Now, what's really awesome is if we look at the total interest, this is what you would spend on this loan over 30 years, $542,902. So your total savings is $286,000. Now, the other really cool part is the all-in-one loan is built on a 30-year draw. So for the first 10 years, you have access to $520,000. So let's say you pay down this loan. At any point, if you need, you can take it back up to $520,000. Now, the question everyone's asking, what's the interest rate? The interest rate is a margin on top of the SOFR rate. The SOFR rate stands for Secured Overnight Financing Rate. And really what it is it's attached to the federal funds rate. And the federal funds rate over the last 25 years has averaged near 2%. It's actually a little bit lower. So the SOFR rate over the last 25 years has also mirrored this. Compare that to a 30-year fixed. The average rate for the last 25 years is 5%. Now that variable rate, just that term, scares a lot of people. But just note that the SOFR rate does not change drastically. It's not going like a full percent higher, right? You would know if it was going to. You would hear a lot of stuff on the media because this trends with the federal funds rate. Next question a lot of people have is, what is the payment? So if we're looking at monthly payments, with the all-in-one loan, the payment changes every month because it's determined off of the principal balance of your loan. So as you pay down the principal, the payment required changes because it's an interest-only payment because we are paying principal first. Meanwhile, your payment on a 30-year fix stays the same. Now, if you want to see the craziest thing, these options that I've showed you is based off of the highest margin. So again, the rate is a margin on top of the SOFR rate. Right now, I have it at a 4% margin. So you can get anywhere from 4 to 2.5%. The better the margin, usually the higher the fees, but you also get special incentives for credit score and equity in the home, so down payment. But let's compare a 4% versus 2.5%. They'd pay off their house 10.4 years. If you had a 3% margin, pay off the house in 10.8, 4% margin, pay off the house in 11.5. Now, when you're looking at the total cost of borrowing for any type of loan, there's one number that you should pay attention to, and that number is called APR. And with the all-in-one loan, the APR in this scenario is 2.875. On the 30-year fixed, it's at the interest rate that we are competing against. And it's honestly probably a little bit higher because APR is the total cost of the loan for all the interest that you pay and all the fees that you pay and the points. So we have an effective APR of 2.875. This is almost like you got an interest rate back in COVID at 2.875. And that's the real power of this loan. Now, this average minimum monthly payment, this is the average of all the payments combined of what it would be. This is the average, right, of the reduced principal monthly. So you want to keep all of this stuff in mind. But if we are comparing across the board on all these different scenarios, the all-in-one loan blows it out of the water. So who do numbers like this actually make sense for? Really, anyone with positive cash flow. You don't have to be super high net worth. All you got to have is positive cash flow, because with the positive cash flow, you are drastically reducing the amount of interest that you pay, all the while retaining access to the equity at any time. Attached to your house, you have a debit card, checks, and bill pay, just like a traditional checking account. The only difference is now the money in your checking account is working smarter instead of harder. Now, here's the thing. This example that I just ran is not yours, and the only numbers that matter are yours. I'll put a link below so that you can schedule a call or go look at the simulator for yourself and see how it works with your actual numbers. Put in the real balance of your loan, your real interest rate, your real income, and go look at your spending to see what you're actually spending and what you're saving. There's no call required. It's no pressure, but I am here if you have any questions. You can book a link directly on my calendar or text or call my number at any time. And if you have any questions that could help the community, drop them in the comments below. We make sure to reply to every single comment. That is the all-in-one loan ran with some real numbers. Now go run yours.